Good morning, everyone. Welcome to today's breakfast meeting brought to you by Vetiva Capital Management in partnership with Frontier Africa Reports. On our agenda today, we will have a review of MTN's and Total's 9 months results by our junior analyst, Victoria, followed by the usual rundown of the equities and fixed income markets by our traders, and conclude with headlines from across Africa brought to us by our media partners, Frontier Africa Reports. At this point, we would like to remind everyone that this meeting is being recorded and the audio files may be shared with third parties. We're also live on our Vetiva online Facebook page if you'd prefer to join us from that platform. Finally, during the duration of the 30-minute session, you may send in questions using any of the chat functions available on Zoom or Facebook. However, at the end of the session, we will have a Q&A segment, and if you prefer to speak, you may utilize the raise hand function. We will now start the session off with our junior analyst, Victoria, who will be giving us a review of MTN and Total's recently released 9 months results. Good morning, Victoria.
Good morning, Angela. Good morning, everyone. So as she said, I'll be reviewing MTN and Total's 9-month result, and I'll start off with MTN. So in its recently released 9-month result, the performance was impressive by all metrics. We saw revenue grow by 24% year-on-year to come in at 1.2 trillion, just in line with our estimates. Growth in revenue was supported by a 52% bump in turnover from its data services. That particular revenue line item has been expanding and witnessing unprecedented growth, just as we have seen an increase in smartphone adoption and penetration. Its other major business segment, that's the voice services, also witnessed moderate growth of 9% year-on-year for the 9-month period. Looking at the quarterly performance, it was also notable as we saw revenue rise 23% year-on-year, and it was also supported by a 57% rise in turnover from its data segment. Further down the income statement, just as we expected, due to inflationary pressures and the current FX challenges, the company, as we know, the company very much relies on FX to import its infrastructure for its operations. Thus, we saw operating costs rise 18% year-on-year. For context, its direct operating costs rose 18% year-on, 32% year-on-year. Nonetheless, EBITDA margins improved to 53% from the 51% we saw in Q3 last year. This was because its excellent top-line performance helped cushion the effect of surge in OPEX. As such, EBITDA grew 18% year-on-year, while profit after tax came in at 106 billion, which was 49% year-on-year rise. Moving on to Total. Total also posted an excellent performance. It was able to grow revenue by 60% year-on-year to 242 billion. Its revenue growth was driven mainly by an increased demand from petroleum products, as we have gradually come out of an era of lockdown and movement restrictions. It's also noteworthy to mention that this period's performance has been the best so far in the last 5 years. Their Q3 performance also recorded growth across all business segments. Sales from its fuel operation was up 208% year-on-year, while its lubricant operation posted an 88% growth. For profitability margins, the gross margins for the 9-month period also improved year-on-year from the 14% we saw in 9 months 20 to 17%, but however remained unchanged for the quarter. The operational results were also better as the operating expense margins went down to 9% from the 15% we saw in Q3 last year. Another notable metric for Total was that its finance cost for the 9-month period was down by 49%, and it was also down 6% on a quarter-on-quarter basis. And this is very notable because we saw that they had paid down their older borrowings and still took on short-term debt in the period. We attribute the decline in interest in finance costs to better negotiation of interest rates. As such, its net income for the quarter came in 413% higher year on year and was a 4% improvement quarter on quarter. We have revised our expectations for both companies and will publish our reports later on today. Thank you. Over to you, Angela.
Thank you very much, Victoria. Speaking next, we have Cynthia from our Global Equities Desk, and she'll be taking us through some markets across West Africa. Good morning, Cynthia.
Good morning, Angela, and good morning to everyone. So like she mentioned, I'll be doing a recap of yesterday's activities in the Ghana and the Nigerian. And in Ghana, we saw Benzo oil palm continue to climb after being the best performing stock last week. So the consumer goods company closed up 10% yesterday, ending the session as the sole gainer, leading to a 6 basis point gain in the composite index. Market activity traded mixed, with volume declining by 79%. As MTN Ghana accounted for 62% of total traded shares. Going into today, we expect a bit of recovery in terms of market activity as investors continue to trade in line with earnings report. In the Nigerian equity space, we saw the market start the week on a negative note, shedding 15 basis points as investors predominantly in the banking and gas sectors. In banking, we saw a bit of sell-off in ETI after accruing about 57% capital gain in the past month. Overall, we had quite a number of banking stocks lose points yesterday to FBN, Fidelity, UBA, just to mention a few. This could be attributed to how well some of these counters performed last week. Speaking to market activity, total traded volume improved by 12%, while turnover also grew marginally by 6%. However, we did see market breadth turn negative as more stocks crashed down compared to the advancers. We expect market to trade mixed today, given the profit-taking activities seen yesterday, while general market sentiment was still driven by corporate earnings and disclosures like we have seen in ICO. The stock has gained 42% in the past 1 week since its announcement of bonus share issuance. And that'll be all from the equities desk.
Thank you, Cynthia. Up next, we have Omar Gay, who would give us a review of the Nigerian fixed income and currency markets. Good morning, Omar Gay.
Good morning, everybody. System liquidity declined slightly yesterday to open at 26 billion negative, coming from the 22 billion negative that was recorded on Friday. Despite the slight decline in system liquidity, interbank rate declined by an average of 550 basis points in the absence of any significant fund loaning in the market yesterday, as OBB and overnight rate closed at 12.5 and 13% respectively. For today, we expect interbank rate to trade at lower levels as OMO repayment of about 103 billion comes into the system. The parallel market traded at 568 naira to $1 yesterday, while the earning window opened at 414.12 naira to $1. The highest rate that was recorded yesterday was 444 naira to $1, while the closing rate was 414.98 naira to $1. Brent and WTI gained about 0.3% and 0.2% to open today at $84.99 and $84.24 per barrel respectively. The TB's market traded on a quiet note yesterday with bullish sentiment observed on the mid to long dated maturities. We witnessed interest on the long dated papers, especially on the 25th August 2022, 28th September 2022, and the newly issued 1-year paper, that's the 27th October 2022 maturities, while trades were executed on the 28th July 2022 and the 27th October 2022 papers Overall average benchmark rate declined by about 12 basis points to close yesterday at 5.17%. The OMO market also traded on a muted note yesterday, with activities seen on the February 2022 and the March 2022 maturities. Few trades were consummated on the 16th November 2022 and the 18th January 2022 maturities, while average benchmark rate declined by about 28 basis points to close yesterday at 5.97%. The bonds market opened the week on a muted note with little activity seen across the benchmark curve. We observed interest majorly on the 2026, 2036, and the 2050 maturities, while trades were consummated along the short to mid-end of the benchmark curve, especially on the 2025 and the 2037 maturities. Overall average benchmark rate remained unchanged at 11.98%. The Eurobond market opened this week on a very active note, with sell-side pressure seen across both the sovereigns and the corporates. The most actively traded sovereigns yesterday were the Nigerian 2025, 2027, 2031, 2032, 2038, 2049, and the 2051, while the most actively traded corporates were the Access Bank PEP, EcoBank 2026, EcoBank 2031, and the Fidelity Bank 2022 Eurobonds. For today, we expect the bonds market to continue to trade weak sentiment as investors cherry pick attractive offers across the benchmark curve, while we expect the T-bills market to trade actively as investors seek to reinvest inflows of about 103.8 billion from OMO repayment. That will be all for fixed income. Thank you.
Thank you for the updates, Amarge. Lastly, we have Justina from Frontier Africa Reports, bringing us news headlines from across Africa. Good morning, Justina.
Good morning, Angela. Good morning, everyone. Yeah, we start here with the current the conference, the UN Climate Change Conference, which is currently holding. The leaders yesterday decided on 3 key things, which were stop funding of overseas coal plants, fight methane leaks, and limit global warming. The government of Angola has reduced the VAT rate applied to basic food products and food basket products from 14% to 7%. Meanwhile, Airtel Africa and UNICEF has announced a 5-year Pan-African partnership to help accelerate the rollout of digital learning through connecting schools to the internet. Airtel Africa is set to contribute $57 million over 5 years to 2027. Nigerian Securities and Exchange Commission says it will intensify monitoring and surveillance of capital markets in order to curb unethical conduct among market operators. Egypt's Financial Regulatory Authority has amended margin trading rules, which allows MISEL for Central Clearing and Depository Registry to supervise the implementation of margin trades through the FRA and the internal trading system. Algeria has ordered the termination of the contract for pipeline crossing to Morocco. In the East African region, inflation rate in Kenya slowed to 6.45% in October from 6.91% in September. Meanwhile, Uganda President Yoweri Museveni is counting on Total Energies and the China National Offshore Oil Corporation to produce oil from its fields in 4 years, laying the foundation for a new regional fuel hub. Right now, the East African nation expects to reach daily output of 230,000 barrels starting from 2025. That's all we have from Frontier Africa Reports. Thank you for listening.
Thank you, Justina. We would like to announce that our economist Ibukun will be speaking on extracting the e-Naira on Friday this week at the breakfast meeting. So we look forward to seeing you on Friday. We have now come to the Q&A segment. And so if you have any questions for our speakers, you may send them in using the chat function on Zoom. If you're joining us on Facebook, you may use the comment section. However, if you'd like to speak, you may indicate using the raise hand function and you'll be called upon. I think we have our first question. It says, good morning. We saw significant upside in both top line and bottom line for most of the downstream names in the oil and gas sector, from Total to Etena. However, we didn't see this in Androva as the top line had a marginal growth while bottom line was significantly down. Any reason for this, and what's the guidance for FY 2021? I think this question will be directed to Luke.
Thank you, Angela, and good morning to everyone listening. Looking at what we've seen so far in the downstream space, like the question goes, right? For Total, I mean, we saw an impressive top line growth, which was mainly driven by higher pricing and recoveries in sales volumes. We also need to mention that for Total, the company has been quite strategic in terms of being able to get good businesses with quite a number of companies, and that has really helped to drive our turnover growth. For Aldova, really, we've not seen that play out in the performance so far this year. So one of the major reasons is the fact that, unlike Total that has been able to get good deals with some companies, that hasn't really been the case for Aldova PLC. And then speaking in terms of bottom line, I mean, for Total, we've seen like a significant growth in bottom line, but that hasn't been the case for Aldova. And the reason for this is more of operating efficiency, right? For Total, the company has been able to really keep costs very low. Also, economies of scale is really supporting the operations of Total PLC. I mean, clearly is the industry leader, and in terms of cost, it's also the cost leader. So for Aldova PLC, given given the high level of inflation, we saw cost pressures really impacting the performance of the company, and that was what really affected bottom line. Also, the company recently raised some debts, especially in the form of bank overdrafts, given that margins from petroleum products really dropped significantly, especially in the second quarter. So that really affected its operating cash flows. So the company had to raise some short-term debts, like bank overdrafts, to support its working capital. So that's pressured finance costs and also weakened net profit for the company. So these are the major reasons why we saw like a bit of deviation between the performance of Total PLC and Aldova PLC. Thank you.
Thank you very much, Luke, for addressing the question. With no more questions, we have now come to the end of today's session. And on behalf of Vetiva Capital Management and our partners, Frontier Africa Reports, we would like to thank you for joining us today, and we hope to see you in tomorrow's session. Have a great day and good morning.